Hi, everybody, and welcome to our Made for YouTube series. Today, we're going to talk about risk as an investor, how you should look at risk, and also it's been 10 months since SEBI's new Riskometer was introduced. So we'll also take stock of how things are shaping up on the ground and how investors can be looking at scheme level risk. Joining in is Ashwin Patni, who's the head of products and alternatives at Axis Mutual Fund. Ashwin, thanks very much for joining in. And of late, risk is becoming a subject that a lot more people want to know about. And we've seen this market rally, which was absolutely crazy. Now we've seen a few days of fall. So people want to be more aware of risk. So first things first, how has this idea changed since the new riskometer was introduced? Do you see investors or clients more cognizant of the risk that they're willing to take?
Hi, Sumaira. Yes, I think clearly we can see what SEBI is trying to do here, which is to make sure that there is complete transparency in terms of the kind of risk is there in the portfolios. It's in response also to some of the concerns that have come out in terms of some of the developments in the industry over the last few years. Having said that, I think it's still early days in terms of investor understanding. Risk at best of times is an extremely complex topic, as I'm sure all our viewers will appreciate as well. What they've tried to do is fairly comprehensive and structured, but I think it's still early days for investors to get their heads around how this whole thing works and how they can start using that in their decision making.
Ashwin, so earlier what used to happen was that, they would say that there's a particular category of schemes, right? Like say large cap funds would have a certain risk profile. Another set of funds would have a certain risk profile. Now what has happened is that even within, of course, equity is just in high and very high category, but let's take debt funds, for example, even within one category, like say, ultra short duration, every scheme can have different risk levels, right? Is it becoming simpler or more complex to select funds, to manage a portfolio?
Yeah, I think at one level, in the old days, there was an element where people used to, as you rightly said, just lump together everything into one bucket. And I think with equity, I think there was still that awareness that wherever you invest, you do get to exposed to equity volatility. But I think we did see it in especially hybrids and debt funds that people assume that all debt funds have a similar risk profile when we all know that anyone who's part of the industry or the informed investors do know that there can be a vast differentiation in different portfolios and how they can impact risk over a cycle. So I think this riskometer is an attempt at bringing out these nuances. Yes, it does complicate things a little bit because you're expecting investors to understand that risk can come out of liquidity, risk can come out of credit risk can come out of duration risk. It's not just one simple thing that debt is less safe or more safe than equity. It's also that all debt is not the same, and within debt, you have to know about liquidity, credit, duration kind of risks. So I would say that yes, it's not easy, but what it does is it brings out these issues in the open and improves transparency, which is a very, very important objective, because then investors know that there are these variables which they need to get their heads around. Because otherwise, there can be a little bit of complacency. There can be a little bit of lack of transparency can cause people to take assumptions and they can get surprised later on, and which is what I think as industry, as regulators, all of us, I think we don't want that to happen.
So Ashwin, now if a person starts off to create a portfolio, naturally they will see their own risk appetite, which is whatever. Like let's assume moderate, right? It's in the middle, and they select the funds which are at or just a shade below. Now over the course of the year, risk and schemes will change. How do they manage their portfolio? Because now a change in funds risk profile is considered a change in the fundamental attribute. Therefore, I mean, what does a person do? Do they keep exiting funds? I mean, not to say that risk will keep increasing, it can also fall. But how do you adapt to these changes?
Yes, and that's a very valid question, because this is basically just for everyone's benefit. This is now, with the latest change that has happened this year, when we look at riskometers, it's not just about the category of the fund, but it's actually directly linked to the portfolio, every month and portfolio. And what that really means is that, as monthly portfolios change, there could be a scenario where the riskometer situation can change from month to month. Now, the way I would look at it is, yes, that's absolutely true. But in most cases, what SEBI has done, and I think this is also subsequent to the scheme classification, and with this riskometer coming in, I think there is greater awareness and transparency of the risk profiles of each of these schemes. So, what I would urge investors to do is, before they invest itself, make sure that they familiarize themselves with the investment strategy, with the objective, with the sort of broad ballpark in which the risk lies, so that a minor change due to some portfolio adjustment does not surprise them, or does not lead to unnecessarily them looking to exit or rebalance their portfolios. If they have done that homework well, it's also a good homework to do, because it makes sure that you're allocating to the right scheme from a longer term perspective. And if you do that homework well, then the chances are that, as you the question you asked, that month on month changes in
Hmm.
portfolio, they lead to this. I don't think they should, in a normal course, lead to anybody taking a big decision like exiting a scheme or
Hmm.
reallocating its portfolio. In most cases, portfolio changes tend to be more in terms of just adopting to the market environment, or adopting to new opportunities, etc., as they get thrown up, and do not lead to any dramatic overhaul in the overall strategy or risk profile of the scheme.
Ashwin, how do investors marry, their risk appetite with, say, asset allocation? Is it the selection of each asset which should fit the bill, or is it that on an overall portfolio level, the risk remains bearable?
So I would say, it has to be done as a top down exercise first, which is to say that what is my overall time horizon, and the kind of drawdowns that I am willing to, because at the end of the day, what everyone is concerned with is drawdown, where all this theory
Mhm.
about risk and portfolio and everything else, where it's finally leads to an actual portfolio implication for any investor, is in the form of any potential for drawdowns. And that's where I think the hard understanding investors have to bring in, which is that what is their horizon, and what is their capacity, and what is their appetite for any drawdowns in their portfolio. I think once they have these big questions in place, that can allow them to start working towards a top level big picture asset allocation, which may say that I have can have so much in equity, so much in debt. This is obviously a core part of any investor's activity. Everyone needs to do this. But where Riskometer then becomes useful is, once you've decided this and you're trying to identify the right equity products, the right debt products, right hybrid products to then populate this asset allocation, brings in that transparency that you're actually allocating to something that works within this construct of asset allocation that you've created. So I think that's where, the two things. I don't think it's an either or. It's actually the two things can go hand in hand, where asset allocation is the core part that investors can do on their own, and then while they're selecting funds, that's where the riskometer or risk profiles, etc., can be used to make sure that they are selecting the correct funds to populate it.
Ashwin, with the evolution of the retail investor, has the time come for even, say, lay investors like me, for example, to start looking at risk as a number? Not, I mean, I understand that there are six levels from low to very high risk, but who's to say what is the difference between high risk and very high risk, right? Or low risk and moderately low risk? Is it time that we start looking at risk more scientifically?
So I think there are pros and cons to that. People have tried putting a number. In fact, even at the back end of this Riskometer is actually a scoring mechanism. So what SEBI has done is they've got a mechanism where each of the different potential attributes which can contribute to risk, as I mentioned in an earlier question, that there could be because of
Mm.
liquidity, it could be because of
Yeah.
credit risk. Just to give the debt example again, so you try to sort of put a number against each of these parameters and quantify them in such a way that it allows you to combine the contribution of risk from these parameters into a holistic picture. And there could also be a scenario, for example, you could be a hybrid fund or a multi-asset fund. So there could be risk contributions coming from the equity part of that, the debt part of it, any other allocations. So you can get a number. And actually, the SEBI exercise actually leads to a number. That number then gets converted into what we see as the riskometer, that high, very high, etc. So the objective, obviously, of SEBI was to keep from a visibility or the way it gets depicted simple, because that dial feature allows you to see in a very simple terms where the dial is pointing. But yes, there is a number. That number is something that all AMCs do calculate at the back end to get the riskometer. And it does there is a value to having this number, because you can combine different aspects of risk together to get a holistic answer. Uh, but at the same time, let me also sort of there's a quick counter view which has to be kept in mind, because all risks are not completely quantifiable. There is also a chance that when we get one number, that we over have an over confident interpretation that this number captures everything, and there could be certain unquantifiable risks which may not get captured here, which is what, if you remember, in many global cases happened in the financial crisis, others, where people got too enamored by very scientific risk models, but they realized that the models didn't give you a full scenario. So I would say broad rules of thumbs work. Use these variables more as guiding lights, more as transparencies to help you get better understanding of what the portfolio has, and make sure that that you don't completely take the entire decision based on a number, but take a slightly broad holistic look of all the allocations and then take a call.
Okay, so Ashwin, would you agree with me that a retail investor should first look at managing risk and that returns will take care of themselves? Is that the right way to sort of construct a portfolio and also, to imagine their investments?
Absolutely. I think we do this analysis every year, where we update fund returns versus investor returns. And it's a very sad exercise every time we do it, because what comes out is that investors invariably flows spike up when markets are doing well. First sign of trouble, people redeem.
Yeah.
Last few months, we have this exercise where flows are going away from the more traditional large cap, multi cap portfolios into sector thematic, higher risk portfolios. These are typical signs of vibrant markets, and it's not a new thing that is happening. It happens every bull market, at the beginning of every at the top of every market rally. We see such behavior, and that is exactly what happens when you start focusing too much on returns and look away from risk. And that's absolutely the wrong approach. People should approach it from a perspective of what is a perfect risk appetite that they have, what is the horizon they have, and then allocate only.
Yeah, absolutely. And even as early as last month, we saw only 14 crores coming into large cap funds as opposed to normally what we see about 900,000 crores, right? It just tells you the entire story. All right, Ashwin, thank you very much for joining in and for explaining this concept of risk and how to look at risk in a real life, practical way. So thanks very much. And for everybody who's watching, I hope you found this useful. Do keep sending us suggestions for future videos that you'd like us to make. So thanks very much for watching. Stay safe.